If you have explored stock market investing, you have definitely come across day trading. Day trading promises some of the best gains in the stock market. Just take a look at some of the moves that these stocks made recently. If you were able to catch the trend, you would have been able to make a lot of money. Even if you did not enter at the perfect time or exit at the perfect time, you would have still gotten really nice gains. And I know I'm showing stocks that are more volatile than the rest of the market, but think about it. If you invested in one of these stocks, you could have had double-digit gains in a single day. To put that in perspective, that's the equivalent of 1 whole year of compounding in long-term investing. But at the same time, day trading has led to a lot of horror stories. This day trader had $37,000 in his stock market account. He shorted some biotech company after they announced that they're gonna liquidate the company, and he was really confident that the stock was gonna go down. However, in after hours trading, some other company announced that they're gonna invest in the company, and the stock ended up going up 600%. And he ended up owing his broker over $100,000, which is twice as much as his initial investment. So day trading does not work for a lot of people, while others claim that it is the perfect stock market strategy. So today we're going to be exploring whether day trading actually works. And just as a quick disclaimer, this video is coming from the perspective of someone who believes in long-term investing, so my views might be a little biased. And my views might be a little biased to tell you to obliterate the like button. Anyways, in order to know whether day trading is legit, we need to understand some common day trading strategies. If we can understand those strategies, we can determine whether there's actually logic behind them. One of the most popular day trading strategies is known as range trading. Range trading is when a stock trader looks for support and resistance lines in a stock chart. And if you don't know, the support lines are the low prices that a stock repeatedly hits, while the resistance lines are the high prices that a stock repeatedly hits. If some trader knows the low and high prices that a stock has been hitting, then it can theoretically give them a good idea of the low and high prices that a stock will hit in the short term. And subsequently, this can give them a really good idea of when to buy and sell a stock. And this sounds like a very easy strategy. All you have to do is buy at the support line and sell at the resistance line, buy low and sell high. But the problem with this strategy is that there's no reason for the stock price to actually obey those rules. There's no reason for a stock to go up after it hits the support line. And there's no reason for a stock to come back down after it hits the resistance line. Just because the market in general started buying or selling a stock at a certain price in the past, it does not mean that they're going to continue to buy and sell that stock at those same prices in the future. A majority of people buy a stock because they believe in its long-term fundamentals. So majority of people will not buy a stock just as it's hitting the support line. Subsequently, the stock price is unlikely to always go up after it hits a support line. So with range trading, there's a lot of hope involved. You're hoping that someone is going to buy the stock after it hits a support line again. And when you're investing real money, you don't want to rely on hope in order to make money. You want to know that you're going to make money. And the lack of certainty with range trading, in my opinion, does not make it a good strategy to use in the stock market. But there's another strategy that has much more sound fundamentals. And this strategy is actually called news-based trading. One way people use news-based trading is by investing in the stock right before the release of their quarterly earnings. If a trader thinks that a company is going to massively beat their earnings expectations, then he would invest in the stock right before the release of their earnings. And if he's right, theoretically he would make money in the stock market because usually after a company releases good earnings, their stock price goes up. On the other hand, if a trader thinks that their earnings are going to be really bad, he would short the stock right before they release their earnings. And once again, if he's right, in general, the stock price is going to go down and then trader is going to make money because stock prices usually go down after a company releases bad earnings. And if you have a really good idea of how much money a company is going to make in the short term, then you can really make a lot of money in the stock market using this strategy. And there are many ways that traders can find stocks that they think will beat their earnings expectation. For example, a trader can look at historical earnings. If a company has a track record of beating their earnings, it could be a good strategy to invest in the stock right before their earnings because they probably will beat their earnings again. But there's a problem with this strategy. And in order to understand why there's a problem, you need to understand some basic things about earnings expectations. Earnings expectations represent an average or consensus of what professional analysts think a company will make. And these analysts are usually very, very close to what the actual amount of money that a company makes. most cases they're usually pretty close. Since professional analysts probably know more about the company and the industry than you do, and since professional analysts probably have a lot more experience in forecasting earnings than you do, it's going to be very hard to beat them and prove that they're going to be incorrect with their earnings estimates. If you are betting that a company will have better or worse earnings than what the analysts think, you are essentially saying that you have a better idea and a better method at forecasting their future earnings than what the professional analysts do. And I'm guessing that you are not smarter than them. I'm guessing that they're gonna be more accurate than you will ever be, just because they do this for a living and they put in hours and hours of work into predicting earnings, and you are just making a guess, which I don't think is a good strategy in the stock market. Once again, you would be relying on hope, and you don't want to rely on hope with your money. But at the end of the day, I could be totally wrong about my assumptions because I'm not a day trader. So let's take a look at what the statistics tell us. According to a quick Google search, about 90% of day traders don't make money. And statistically speaking, that's essentially all of them. And this statistic would imply that only the best and the most skilled day traders actually make money in the stock market. However, before you conclude that, I want you to hear this. A couple of studies looked at the chances that a gambler will lose money over the long term, and the numbers are actually very interesting. One study found that about 86% of gamblers will lose money. Another study found that 95% will lose money, and another study found that 89% will lose money. And what's interesting about all these numbers is that they're so close to 90%, which happens to be very close to the failure rate of day traders. So day trading theoretically could just be another form of gambling because they're so strikingly similar. With day trading and gambling, you're relying a lot on hope. With day trading and gambling, about 90% of people lose money. And I know some people in the comments are gonna say,
but Daniel, with day trading, there's an actual strategy and an actual plan, but with gambling, it's all hope.
But you have to keep in mind that gamblers also do have a strategy. They actually do have a ton of strategies to minimize risks and try to maximize their return. But at the end of the day, those strategies don't work. So at the end of the day, day trading and gambling are very similar. But keep in mind that these are only my opinions on day trading, and there are probably some day traders here and there who are making money through it. But I would not recommend it as a strategy for most people who are getting into the stock market. But other than that, I hope you like this video. Make sure to drop a like and subscribe, and check out some of my other videos on the stock market.